Ready to begin? Bonjour tout le monde. Good morning, everyone. My name is Antoine Baillargeon, and I'm the program coordinator here at the Ottawa Branch of the National Association of Federal Retirees. I'd like to begin by acknowledging that the Ottawa Branch is located on the unceded territory of the Algonquin Anishinaabe Nation. We extend our respects to all First Nation, Inuit, and Métis people for their valuable past, present, and future contributions to this land and country. On behalf of the Ottawa Branch, I'm pleased to welcome you to today's webinar titled The New Gold Rush, Strengthening Your Portfolio's Foundation with Michael Fine. Michael has delivered many financial literacy webinars with the Ottawa Branch over the years, and we're delighted to have him back this morning. Before we begin, I want to give a special welcome here to anyone who is not yet a member of the association. We hope that these webinars will inspire you to join us. And to our members, we hope that these webinars will encourage you to maintain your membership with us. I also want to mention that closed captions for this webinars are available in both French and English. So to access this feature, please click on the closed captions button at the bottom of your screen. And to translate to French, please click on the little arrow next to the closed captions button and select the translate option. Finally, if you have any questions for Michael, please type them in the Q&A box, and Michael will be able to answer them after his presentation. So that's all for me, so I'll pass it over to our presenter, Michael Fine. Thank you, everyone.
Great. Thank you. Good morning, everyone. Just to mention as we get going, we've got a couple of questions at the beginning of the presentation, and a question there will pop up. You just vote on the answer of your choice. It's all completely hidden, but you'll be able to see what everybody's response is. So let me take just a minute here and get ready to share the slides. Okay. I think Antoine, double check and make sure that we are sharing the video properly.
The share is not on right now, but you should be able to start the share now.
Okay. Is the audio share on?
Well, right now the share hasn't been started.
Okay. Let's go back and try again.
Okay, now we can see your screen.
Now we can see the screen, and I want to make sure that the audio is on. Where do I do that, Antoine?
Well, was there the option when you started the share screen to share your audio?
No, I didn't see it.
Oh,
Let's try. Okay, I got it here.
okay, perfect.
I think so. No, I'm not sure it's working. Anyway, we will try. Hopefully, we'll get it working. So, ladies and gentlemen, obviously we're talking about the new gold rush here and talking about how gold may have a valuable presence in your portfolio. At the beginning, I want to read the usual disclaimer that nothing in this webinar is a recommendation to invest in gold. Please do your own due diligence or consult with a licensed investment advisor before investing in any investment product. And this webinar is for general information only. So we're going to start by asking a couple of questions, and I'll get Antoine to pop this up. And basically just want to know if any of you already own some gold, either in physical format or through gold mining companies or through different sorts of ETFs. Please vote now. Okay, so we've got everyone voted, and about what, 40% of you own some gold. So that's good to know. The next question we have is, how many of you are familiar with exchange traded funds? Again, please just vote yes or no. So about 76% are familiar with exchange traded funds, which is great. For those who are not familiar with them, let me just briefly say that exchange traded funds are similar to uh, mutual funds, but they are bought and sold like a stock. And as a result, they tend to have much lower costs of ownership, and they're a lot easier to buy and sell, and have a number of benefits that simply make them often a better way of purchasing things. So let's go on to the next. So let's talk a bit about why the price of gold has increased so much over the last couple of years. One of the main reasons has been central bank purchasing. So central banks around the world, particularly China, but many others, have been buying about 50% of the world's annual gold production. And where they used to hold US securities, for example, government bonds and such like, they have been replacing them over the years with gold. And the reason that they're doing that is because they wanted to diversify their exchange holdings away from the US dollar, for a bunch of reasons that we'll talk about in a minute or two. The other reason that gold has increased so much is because of the enormous fiscal debt and deficits in the world. Government debt right now in total around the world is $111 trillion. And I'm going to show you a graphic in a minute that shows you how that has increased over the last 25 years. The US debt alone is 39 trillion, and the annual deficit is 2 trillion. So that means the US debt's going up by $2 trillion a year. At this rate, the US government's interest payments are going to be about $1.3 trillion in 2026. So about 60% of that deficit is simply now interest payments on the debt, and that's going to climb every year. So the US government debt to GDP ratio is about 124% today. And basically anything over 100%, people start to get worried about the ability of the government to pay its interest. In Canada, the debt to GDP ratio is considerably lower at 45%, but the United States is in a much different place than Canada because with the US dollar having been the world's reserve currency, they can frankly get away with a lot more debt than we can. So this is an interesting graphic that shows how debt has increased over the last 25 years. If you look at the US on top, it's gone from about $5 trillion to $39 trillion. Call it 40 trillion soon. So that's an 8 times increase. But it's interesting also, look at China down below. It's gone from almost no debt to $18 trillion in debt. And this amount of growth in debt is rapidly getting to a point where people are thinking maybe this is not sustainable. Like anybody else, you just can't keep borrowing forever. Another reason why the prices have increased so much is geopolitical turmoil. I mean, we all see what's going on today in Iran, the Strait of Hormuz, the oil and gas blockade, the potential for recession being caused by the price of oil going through the roof. We're basically in a period of a great deal of unease. And when people get uneasy, they turn to gold. One final reason, which kind of relates back to all the other reasons, is Donald Trump. As Pierre Lassonde, who's one of the gold gurus of Canada, has said, the best thing for gold is Donald Trump. Virtually all the things he's doing and the decisions his administration are making by increasing tariffs, running huge deficits, wars, are all things which create a condition that supports the price of gold. The other thing that you should be aware of is the potential impact in the future of artificial intelligence. If you haven't been using artificial intelligence, please do yourself a favor and try to use it. Use Gemini from Google or Claude from Anthropic. These are amazingly powerful tools. And in fact, as we go through this presentation, you'll see the graphs here. They were all done for me within minutes by Gemini. I just asked it what to draw. It went out, found all the information, drew the graphs. Frankly, I think artificial intelligence is going to be a great productivity booster, but in the process, I think it's going to create havoc, particularly in the area of white collar entry level jobs. And that could lead to recession, and that could lead to more demand for things like gold. So I'm going to run this short video here, and I'm hopeful that we've got the audio working, but I'm not convinced. Let me just see if I need to do anything. And I don't know, Antoine, if you can let me know one way or the other if it's working.
Sure. Yeah, you can start it and I'll let you know.
Okay, let me just flip back here.
But let's bring in some
Yeah,
expert
all good.
analysis here. He's one of the most respected names in mining. He's chair emeritus at Franco-Nevada. We are joined by Pierre Lassonde. Pierre, thanks very much indeed for joining us. Really appreciate it.
It's a pleasure. Always a pleasure, Andrew.
What a year for gold. I think we have a chart showing gold this century, and it's been a great asset to own. Although it got to records in 2011, as you know, and it was fallow for a few years after that. But certainly the gold fans have been vindicated this year.
Yeah, no question about it. I think that what we're looking at today is a situation similar to the late 1970s, when you saw the price of gold going from essentially $90 to $800 in a space of 3.5 years. And that happened in a context where you had, high inflation at the time, and essentially you had stagflation. And today, when you look at the U.S., particularly Mr. Trump's cornucopia of regressive tariffs, profligate spending, and eye-watering fiscal deficit, that's a toxic cocktail for more stagflation. And also, it brings into question whether the U.S. dollar is really a safe haven. And that's why you're seeing central banks buying, you're seeing the ETF, all of the gold ETF having record amount of input of incoming money. And I think that 2025 was a fantastic year, but 2026 is probably going to be a new record year again.
For similar reasons, you think those same forces are still at play?
Very much so, very much so. I mean, the U.S. has weaponized the dollar, and nobody likes to get kicked in the nuts too many times. Okay, so You look at China, well, they used to hold like 3 trillion of US dollars. Well, they've cut that, tremendously. And what are they doing? They're buying gold. And so are, Turkey, and look at the number of countries buying gold. It's really amazing. And so when you're buying gold, like half of the world's production is going into central banks. So that leaves, only half, which is about like, 1,800 ton for everybody else. And if you're trying to move $1 trillion of saving into gold, the gold price will be like 17,000 plus.
So that's what Pierre Lassonde thinks of gold. So let's talk a little bit about the opposite. Why has the price of gold decreased so much lately? Because it hit a high of about $5,600, and today it's around just under 4,700. Two reasons that have come to light from my reading. First of all, there was a flight to liquidity when the Iran war started. All of a sudden, a lot of countries needed to have US dollars to pay for their inputs or imports, primarily the oil that they're bringing in. So as the oil price has gone through the roof, countries had to convert gold to US dollars to buy oil. But also a lot of countries who are affected by the blockade of the Strait of Hormuz, all of the Persian Gulf, for example, they had to get liquidity to have enough exchange to keep on importing all the things that they needed. So this has had a significant impact. Also, frankly, I think the price of gold just got a little out of control and went up too far too fast. So let's talk now about how to own gold. Um, you can buy physical gold. For example, you can buy gold coins or gold bars. Costco has been selling them. I think you can even buy them online from Costco, and they'll ship them right to your door. You can go to the Royal Canadian Mint and either buy them directly there or buy them online. And there's other places where you can buy physical gold, both in terms of little bars or big bars and coins. But make sure if you do buy them, you buy from a reputable seller and avoid scams because there's a lot of fake gold out there now. Problem with physical gold, if you have a significant amount, you've got to pay to put it in a lockbox somewhere in a bank, and the cost to sell it is quite high, typically 5%. A better alternative is to buy what's called a physical gold ETF or exchange traded fund. And these are basically funds that I mentioned that are bought and sold like a stock. So the largest one, the symbol is GLD. It's in US dollars. It currently has a net asset value of about 167 billion. It was actually co-founded by the person you just heard from, Pierre Lassonde, when he was chairman of the World Gold Council. It has a MER or fee of 0.5, 0.5%, which is not unreasonable. You can also buy something similar in Canadian dollars, the symbols XGLD or CGL, and their fees are between 0.25 and 0.5. The nice thing about these are very easy and inexpensive to buy and sell. If you have a discount brokerage account, it's $0 to $10 to make a purchase, and you can sell them in seconds. So they're fully liquid, no storage costs, very safe. Another way to own gold is to buy a gold miner exchange traded fund. In other words, this is a fund that owns, in this case, XGD, which is a Canadian one, 50 countries or 50 companies around the world. The fee is 0.6. Again, fully liquid. You can buy and sell it in an instant, and it provides a leveraged exposure to the price of gold, both up and down. And then if you're a bit of a risk taker, owing gold through gold miners can actually be the most profitable way to do it. Here's an example. So let's say gold is selling at $4,700 an ounce, which is about what it is today, and it increases to 6,000. So that's a 28% increase for you. But let's look at the gold miner. So the gold miner, the average all-in production cost is about $1,700 today. So at $4,700, that gold mining company is making a $3,000 profit, which is insanely good. But if it goes to $6,000, they make a $4,300 profit, which is a 43% increase in their profit. So while gold goes up 28%, the gold miner profit goes up 43%. So that's roughly 53% more than gold has gone up. So if you believe in gold, gold miners through an ETF gives you the maximum exposure. But higher potential profit means higher risk. You never get one without the other. So let's look what that looks like. So here's a chart that Gemini drew for me, and it compares GLD, the US dollar gold bullion ETF, with Ring, which is a US dollar gold miner ETF. It's basically the same as XGD. Same company, just US dollars. So you can see up until about 2025, beginning, they pretty much went hand in hand. But starting then, people began to realize how much money these gold miners were making. And the gold miners took off in value compared to gold, which is the blue line. So you can see gold in this period went up 126%. The gold miners went up 211%. But look at this. This is the recent retraction in the price of gold and gold miners. So while gold came down this amount, you can see that the gold miners came down a lot more. So that leverage plays both ways. Clearly, if you're a risk uh, um, a person, you like having risk, then gold miners is the way to go. If you are risk adverse, you don't want to do this. The other way to own gold, and frankly, my preferred way, is through what are called gold royalty companies. And these are companies that rather than owning and operating gold mines, they invest in potential mines at an early stage, and for which they get a certain percentage of all the gold produced, maybe 1 or 2%. The granddaddy of them, Franco-Nevada, again, was actually established by Pierre Lassonde, who you heard from earlier. It had its initial public offering, its launch, in December of 2007. And since that time, it's returned 17% compound average growth rate. That's way ahead of the stock market. The nice thing about it is that it has no operating risk. Doesn't matter what happens to the price of fuel or anything else. It's highly liquid. They have investments, active investments from about 40 different companies, and highly liquid, so you can buy and sell it right away. Two other gold royalty companies are Wheaton Precious Metals and Osisko Gold Royalties. So let's take a look at how they have operated. So here we've added Franco-Nevada into the graph, comparing it to gold here in the blue and Ring, the gold miner ETF. And you can see that Franco has lagged the others. It hasn't had the same increase. There's a reason for that, and that is that right here in early or late 2023, one of its biggest investments, a mine called Cobre Panama, was closed down by the Panamanian government for various reasons. And that took a big chunk out of Franco-Nevada's revenues. Despite that, the stock has still done well. And most analysts think that this Cobre Panama mine is going to reopen within the next 6 to 12 months. Anyway, the point being that you can see in the latest turn down, it turned down a lot less than the gold miners ETF. So it's safer, but you trade off the gain for less risk. How do you buy ETFs and royalty companies? Well, through any broker or financial advisor, generally not through any bank because they're not licensed to sell these things. Or if you have a direct investing account, you buy it just like you do any other stock. By the way, I should point out, I'm not keen on owning individual mining companies because I think there's too much risk involved. You can have mine closures, like I just explained in the case of Cobre Panama. And you really have to know what you're doing to pick a mining company. And frankly, it's beyond my level of competence. So how much gold should you own? I'm going to play a short interview with Ray Dalio. Ray Dalio is a multi-billionaire. He was the co-founder of the largest hedge fund in the world called Bridgewater Associates. And he spends a lot of time looking at where we are in the economic and geopolitical cycles and trying to figure out how you protect your portfolio. Listen to Ray.
When you're thinking you're doing your asset allocation, what is going to protect your real after-tax returns so you create that optimal mix? Gold is a very excellent diversifier of the portfolio. So if you were to look at just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold because of the fact that if you didn't even have a tactical, because it is the one asset that does very well when the typical parts of your portfolio go down, because the typical parts of your portfolio are also so credit dependent. So anyway, I think all of this means that there should be some piece in that of gold. If I'm making tactical bets, I don't like debt assets per se. And I would say I don't like debt assets per se, not just government debt assets, but also if you're looking, let's say, at credit or private credit, and you look at where the credit spreads are very, very low. And so for those various reasons, my tilts would be away from those things.
And toward gold.
But again, yes, so more than would be a normal asset allocation mix.
So let's just look at what gold has done over the past 20 years and see how it has reacted. So the blue line is the S&P 500 index over that period of time, and the gold line is, of course, gold. This is the financial crisis of 2007, 8, 9. And as you see, when the stock market tanked, gold did the opposite and went up substantially. And then gold has kind of leveled off. Here we get to the COVID crisis, and you can see, if you remember, the stock market tanked briefly. It doesn't show up here, but it went sharply down and then up. Gold went up. But what's interesting is that gold has continued to match the S&P 500 ever since then, so that its compound average growth rate over this period, 20 years, is about 8%, and so is the S&P 500. Again, just want to point out, thank you to Gemini for drawing this graph for me and finding the information. So I want to play you a song by a great artist and gold investor.
Michael, we can't hear the song.
try to give. Keep me searching for a heart. Oh, yeah, keep me searching for a heart.
Well, thank you. Hope you enjoyed that little musical interlude. So, in conclusion, and just before opening it up to questions, uh, my mantra in all this, and that I recommend to everybody, is prepare, don't predict, which is a quote from another great investor, Howard Marks, who said, we can't predict the future. We have no idea what's going to happen, but things are going to happen. And you have to really consider almost the worst that might happen and prepare for it. And one of the ways to prepare for it, I think, is to have some gold in the portfolio. And with that, I will stop the slide share and turn it back to Antoine for questions.
Perfect. Thank you, Michael. So I encourage anyone here in the webinar to ask your questions in the Q&A box on Zoom, and we'll be able to see your questions and read them out for Michael to answer. So far right now, we only have one comment. I think it's not really a question. It's relating to one of your earlier slides. As of early 2026, Canada's total government gross debt to GDP ratio is estimated to be around 110 to 112%, combining federal, provincial, and local levels. So that's the comment.
Yeah, and that's true. I was only using the federal government debt numbers so that I could compare apples to apples because I was using the debt number in the US, which is federal government only. But yes, it's true. Both the federal government and the provincial governments have been spending very freely, as has everybody around the world. And at some point, that's going to stop. It's the same with individuals. There's a famous line from Hemingway. Somebody asked him, he said, "How did you go bankrupt?" And he said, "Well, slowly at first and then all at once."
Mm.
That's what tends to happen in these kinds of situations.
All right. We have one question here. Are there any gold investment companies that have high ethical standards for gold mining?
Um, That's a good question. I know that Franco-Nevada is rated very highly in the what's called ESG category, environment, social governance. And you can check out their website to see various awards that they've received for that. I don't know about other individual companies, but a lot of the companies today are very large and very reputable. So, a company like Newmont Mining or Barrick Gold or Agnico Nickel, these are top-notch companies, and I'm sure that they do things in the proper ethical and environmental manner.
All right, so our next question here is, what is the likely impact on gold if oil prices continue upward and if the US slides into a recession?
Yeah, well, it's hard to figure these things out, but if the price of oil continues to go up, it probably will create a recession worldwide, not just in the US. In fact, if you go back to 2007 and the great financial crisis and the housing crisis, it the thing that caused the recession was the price of oil hitting $100. And I remember at the time because I was living in the States when that occurred. And that was the real cause of the recession, which then caused all the other building blocks or dominoes to fall. So if you look at history, if the United States goes into recession, what is likely to happen? Well, first of all, the central bank will cut interest rates. The central bank or the country may have to borrow more money because it can't afford all the social programs that it is offering because it's bringing in less revenue. So they have to print more money. And you end up in a situation that Pierre Lassonde referred to, stagflation, where you've got prices going up, but the economy going nowhere. And that's a very dangerous situation. Back in the great financial crisis, one of the differences was that the government had the gunpowder to be able to come and bail out the banks. But the government doesn't have that gunpowder anymore. They've spent it all. So you could find yourself in a very nasty situation.
Right. Our next question, what about gold jewelry sitting in our jewelry boxes or our safes? Are they worth getting appraised?
Well, if you've got a lot of gold in them, sure. That gold is, worth what in US dollars, $4,700 an ounce right now for 24 karat gold. Um, but you might want to wait for a while and see if the price goes back up to 5,500 or higher, or as Pierre Lassonde says, much higher than that. So I'm not sure it's time yet to cash in your gold jewelry.
Hmm.
I,
This
I don't
next,
have enough to worry about. So
right.
besides, my wife would not be happy if I stole it from her jewelry box.
This next question might be a bit more speculative. How likely is it that the Russians are selling their gold to finance the war?
100% likely.
Okay.
That's exactly what they've been doing. In fact, the Russians got caught because, and it's one of the reasons other central banks have been buying gold. When the war in the Ukraine started, the Americans froze the Russians' U.S. debt assets. And so this money that the Russians had, they couldn't get access to. The U.S. has done this before. Prior to World War II, they did the same thing to Japan with Japanese assets. So now the Russians, the Chinese, and anybody else looks around and says, do I want to have all my assets, my foreign assets, tied up in US dollars? So the Russians did go out and buy gold, and they supposedly have been selling off some of their gold as the price went up a lot, because the price doubled in 2 years. And it is thought that they have been selling gold to help finance their, not so much their war, but just their foreign exchange requirements.
Hmm. This next question, how do you set up with a gold investment broker in Canada? What is the general process for new investors?
Well, you don't need a gold broker. All you need is an account either through a financial advisor uh, or a regular brokerage firm or a discount brokerage. And then you simply work with them to buy the appropriate investment for you. It's once you've got the brokerage account set up, it's very easy. The best way to do it is through an online discount broker, which charges, well, in some cases, like Simple, it charges nothing. But if you're a senior and you're not comfortable doing that, and you've got some grandkids, in their 20s or 30s to teach you how to do it and set it up, that's definitely the way to go ahead. The nice thing about something like, for example, the XGD Global Gold ETF, if you buy through Simple, the commission is zero. When you want to buy it and sell it, it literally takes seconds to buy and sell. And completely liquid, completely straightforward, no scams, no dealing with anybody who's, you know, not reputable. It's definitely the way to go.
Okay, great. This next question might be a bit off topic, so I'll still ask it and you can see if you have a response. Uh, what if you do not believe in holding any personal debt? What is the best way to protect against a government that taxes, borrows, and prints money?
Well, the best way to protect yourself is to hold something like gold, which doesn't depreciate in value. Um, and that's not debt, that's an asset. So what's happened over time is that as governments print money, they basically depreciate the value of their currency. What happens is this: if you've got this very high ratio of debt to GDP, such was mentioned earlier, there's no way that governments are going to stop spending the money for social services that they're spending. They won't get reelected. There's no way that they're going to raise taxes substantially. Taxes are already high. They won't get reelected. So the only way out is to increase the GDP. So if you can't reduce your debt, you have to increase your GDP. The only way to increase your GDP in many cases is either through massive gains in productivity, which AI may bring, but with an awful lot of collateral damage, or you inflate your economy. And you inflate your economy by printing money through your central bank. Central bank basically buying up the government's bonds, which literally prints money. And what happens when you do that is your GDP goes up, but so does inflation, and the value of your currency drops. In those situations, and the reason people like gold is the one thing that doesn't drop in value is gold. And the line is that banks can't print gold. So it is the one thing that you can go to and be relatively certain will hold its value.
Great. We have another question here. Is gold used for anything, quote unquote, practical other than jewelry, or is it just usually used as a holding asset?
Yeah, it gold has a few industrial uses, but it's not a big piece of what gold is used for. Gold is basically today considered as money. In fact, if you go back in time, gold was the money. Up until I believe it was 1980, 72, in the United States, American dollar bills said on them that they were redeemable in gold, and it was at a fixed price of $35.
Hmm.
And what happened was that the real price of gold kept going up in value beyond the $35. And in 1982, President Nixon announced one day that the United States was no longer going to redeem your $100 US $100 bills in gold. And that was what opened up the floodgates for gold. So, um, yeah, it's the thing with gold is that gold is still and always has been considered money, and it's really the only real money in the world. Diamonds are no longer forever now that you can make fake diamonds. Um, so it's gold.
All right. Well, that's all the questions we have right now in the Q&A. So I think we'll stop it there. So thank you very much, Michael, for today's great informative presentation. I hope that everyone here learned a lot, and thank you for your participation and all your questions. It was a great session. And also remember that you can look out for a follow-up email that'll go out later today, and it'll include the recording for today's webinar, as well as Michael's presentation slides if you'd like to go over them. Finally, remember that you can invite non-members to attend our webinars and try us out as a guest. And to register for any of our upcoming webinars, you can visit the Ottawa Branch website at nafrottawa.com. We do have a webinar coming up tomorrow with a longtime branch presenter, Dr. Glenn Kenny of U Ottawa. So if you're interested in that, please visit our website and sign up. It's tomorrow morning. So thank you, everyone, and thank you again, Michael, for the excellent presentation. And we hope to see you at our next webinar. Bye-bye.
Thank you.